Hi all and welcome. My name is William Wilcox. I now work for the City and County of San Francisco as the tax exempt bond manager, but I was previously at the California Housing Partnership. But for this, I'm doing as part of the Emerging Leaders Peer Network at NPH. And I'm on the Policy and Advocacy Subcommittee and got a bunch of great help from Macy Leung from the Professional Development Committee. And I just want to thank you for coming out today to learn more about affordable housing homeownership programs and the amazing work being done by all of our speakers so that we can learn how this can be expanded in our industry. And with that, I'm going to hand it over to Leo Goldberg, the co-director of the California Community Land Trust Network, who's going to moderate this panel and introduce everyone to our other speakers.
Thanks, William, and good to be with everyone. Like William said, I'm Leo with the California Community Land Trust Network. We are 26 nonprofits all across the state that steward and develop permanently affordable community-controlled housing, much of it homeownership housing. And we want to do a couple things, which is we have a couple poll questions that maybe we can put up, and it would be great to see responses from everyone here. And then I'm going to share a couple remarks once our polls are in. So let's see what we got. Okay, so it's looking like to the question, have you worked on affordable homeownership project in your current role? We're at 80% no, 20% yes. And does your organization have programs that promote home ownership? We are at 40% yes, 40% no, 20% not sure. Okay, great. That's helpful. So I want to I don't want to take up a lot of time on things everyone already knows, but I want to establish a few kind of shared facts that we can keep in mind as our panelists share. So the first shared fact about homeownership in California is that California has an extremely low homeownership rate compared to most of the country. We're at 56% at the moment. That's down from being in the 60s earlier in the 2000s. And that's the second lowest of any state in the country. And the causes, I think, are things that everyone here is very familiar with. It's home prices outpacing incomes, underproduction of housing, the legacy of the foreclosure crisis, among other things. And then the second key fact is that homeownership is stratified by race. So 63% of non-Hispanic white families in California own their homes. That's only true for 44% of Latinx households and 36% of Black households. And this is stemming from the legacy of systemic racism, redlining to predatory lending, and of the 1 million Californians that lost their homes during the foreclosure crisis, 2007, 2012 time, a vastly disproportionate number were people of color. So we're still living with the implications of that. And then it's not all in the past, right? We have that stratification is still being perpetuated by disparities in mortgage lending, in appraisals, and property taxation. So I think it's important to keep in mind that it's being driven by market players as well as state policy decisions and programs. And this unequal access to homeownership has huge implications, I think, as most of us know. First of all, it drives the racial wealth gap, which impacts intergenerational economic mobility, health outcomes, a whole range of things that are critical to people's lives. And also something that I think shows up in my work a lot, it impacts people's stability, right? Homeownership is a key way, not the only way, but a key way that people are able to remain in their neighborhood as home prices increase. And in that way, I think it's an anti-displacement measure of its own. And then the last thing I'll share is that, and hopefully someone will disagree with me, but I don't see any indication that the market is going to start serving lower income people who are looking to own anytime soon. California has the third highest percentage of renters who are cost burdened in the country. It's 55%. So renters aren't sitting on fat savings accounts that they're just waiting to turn in down payments. And the forecasts are for home prices to continue to grow in California while interest rates are supposed to rise. So across a bunch of different metrics, it seems like this issue of housing affordability in general, but specifically in the homeownership space, is just going to get tougher. And that's why I'm excited to hear from our great panelists, to hear about their work and how they're approaching that challenge. I think what I'll do is maybe we'll have each panelist introduce themselves as they jump into their remarks. And my opening prompt before we get into other questions is, what does affordable homeownership look like in the context of your work? So we can go Darris, and then Shannon, and then Tom, and Sarah. So if each of you could introduce yourself and speak to that question, that would be great. Darris, I'll hand it to you.
Thank you, Leo. So my name is Darris Young, and I am the Director of Organizing for African American Health for an organization that's called BARHII, and that stands for Bay Area Regional Health Initiative, Inequity Initiative. And our work at BARHII, we mainly focus on the Bay Area's government health departments, and we were founded to work on issues that impact health outside of the doctor's office. And so we've been working intently on housing issues for a number of years. At the moment, our work in housing is on a twofold front. What we are proposing is for creating a Black housing funding pool at the state level. And that is seeking to create these in areas of Black home ownership, asset retention, building, and property acquisitions. Because one of the things that we have seen, and this is how our work really comes into the context of home ownership and affordable housing, is that when we began to focus on this work a few years ago in 2018, we partnered with the Federal Reserve on some original research. And some of that research showed that, housing affordability, as you all know, which was just said, is a central issue, but also for a central issue for health in the region, and not just in the three big cities, which we consider Oakland, San Francisco, and also San Jose. And it showed that there's a particular acute issue when it comes to people of color, especially Black residents within itself, because the compounding impacts of decades long of discrimination, unequal access to wealth, and that's a big one, unequal access to wealth, quality of jobs, and also high housing costs, among other factors. And so what we have done is that we have sought to engage a number of housing initiatives across the region that work. And when we saw time and time again that Black voices were left out of the decision-making process for the future. And so as a result, we convened last year in May, 35 African-American led organizations ranging from policy groups and housing to come up with what we call this Black housing funding pool. Now, keep in mind, I'm gonna try to be brief, that housing is big. The issue in California is big for everybody, especially when we talk about what we call the BIPOC community. But if you look at all of individuals that would fall under BIPOC, there is a big telling disparity when it comes to Black home ownership, but also getting African American renters into affordable housing and also low income housing. And the latter piece bespeaks of the wide gap in homelessness amongst African Americans. And what's so telling, I think it was back in March of last year, the California State Assembly they did a special hearing on housing. And what was really, really, frightening about that was when we saw that in California and in the Bay Area region, especially, African Americans own less housing today than they did before the Fair Housing Act. And that's kind of telling when you think back to 1963, 65, it was an African American legislature by the name of Byron Rumford Sr. He actually authored the first fair housing bill. He was out of Berkeley, California. It passed, it was overturned, but the case went to the United States Supreme Court on a case that was based in Los Angeles. Two Black renters, a couple tried to get into a complex, and the Supreme Court ruled in that, and there was really instated California's fair housing law, which actually became the blueprint for the bill that was eventually passed in the state. So I say all this to say that what we're working on are the solutions, and they're not to say that other solutions as well, because right now we need everybody who is working on housing in some capacity. And I say that our work is just complementing other works that's already happening. So thank you.
Thank you, Darris.
You're welcome.
And Shannon, we'll kick it to you.
Great, thanks. My name is Shannon Way. I'm the Executive Director of Homeownership SF. We are a nonprofit coalition of the 5 HUD-approved housing counseling agencies in the city of San Francisco, which are Asian Inc., which is formerly known as Consumer Credit Counseling Service of San Francisco, the Mission Economic Development Agency, San Francisco Housing Development Corporation, and the LGBT Community Center. So these agencies provide a whole series of asset building programs, housing counseling, homeownership education, foreclosure prevention, and also are the agencies that do the homebuyer education that is required for all of the City of San Francisco homeownership programs under the Mayor's Office of Housing and Community Development. And then what we do is that, Homeownership SF as a coordinating body, we act as an access point for the community. There's a complicated landscape of services available in San Francisco. A lot of times people don't know where to go to get the services that will, best work for them, or to be able to access services in a particular language. People can come to homeownership whether they are currently experiencing homelessness, maybe they're a population that is vulnerable and in need of rental assistance or affordable rentals, or if they want to purchase a home, or also if you own a home and need help to sort of navigate asset protection, or again, foreclosure prevention. And then we also, for our agencies, we coordinate services so that they can teach each other, have peer sharing, coordinate around trainings, and then also events, which we annually hold the San Francisco Housing Expo, which is the largest affordable housing resource fair in the city. And if you're interested in that, we will be announcing the dates for 2022. It'll be held this fall. So you can find us on social media and follow us there to be the first to get updates about the 2022 Housing Expo. And you'll see that, homeownership is kind of in our name. That's our, sort of a reason to tear, in the sense that that's where we came on the scene during the foreclosure crisis in 2008. But we do obviously work with a wide range of housing programs, including rental housing. And we really actually decided to keep the homeownership in our name, because there are so few organizations that are really holding the candle for low to moderate income homeownership, and for first-time home buyers to be able to get their foot in the door. And so, we're definitely excited to see in the city of San Francisco, there has been a renewed interest more recently, but there's still a lot of people out there who have either given up on homeownership, think it's not possible for low to moderate income households, or for other reasons just oppose it. And so, we really want to make sure that we highlight the fact that this is an important, it's the largest, wealth generating thing for most households. And, and also from a diversity and inclusion perspective, we can't have the housing climate and discrimination that we've had for the last 100+ years, and then suddenly decide we're going to pull up the ladder and now nobody gets have access to homeownership anymore. Obviously, that's not equitable. So I mentioned that our agencies provide the education for the city of San Francisco homeownership programs. There are essentially two big programs. None of these are sort of radical or innovative. These are strategies that have been around for a while. There's the inclusionary housing, so the below market rate or BMR units, and then down payment assistance, where somebody can get some capital front that sits as a silent second to be able to reduce the cost of a market rate home, to purchase a market rate home. Our inclusionary units, those are permanently deed restrictions. The unit is what is priced lower, as opposed to the down payment assistance, where the home is a market rate, sort of price, and and then the restrictions and everything that's associated are tied to the loan, the second mortgage. Both of these are designed for first-time home buyers and do require that people be owner occupying the property. This isn't a game to we really want this to be a way of keeping people in San Francisco. And then both programs are based on area median income. And area median income for City of San Francisco, we use an adjusted median income. So we kick Marin out because they mess up our numbers and make the prices too high. But there's different targets, income targets. And this, sort of takes into consideration household size as well as income. And then that allows the programs to sort of serve the range that is, based on the way that they are designed. So for the down payment assistance loan program, there's you can get up to $375,000 towards the purchase of a market rate home. That is, again, a silent second, so there's no payments due until you either refinance or sell the home. There's also, in addition to the citywide DALP, there's programs that are specific. There's a set aside for first responders, and then also some educators for the San Francisco Unified School District. And then our newest addition to the down payment assistance portfolio is the Dreamkeeper initiative, which really is about preserving Black homeownership and increasing Black homeownership in San Francisco. So, those are pretty straightforward. They, again, apply towards a market rate home, and then at sale or refinance, the city does take a recapture of the equity. So if no equity is earned, say somebody has to turn around and sell quickly, there would obviously not be a fee associated with that program. But if somebody's able to gain equity that they wouldn't have otherwise had, then that amount, there would be a certain percentage of that equity piece that gets recaptured and goes back into the program to make it sustainable, so that it kind of feeds itself. For the below market rate units, or the BMRs, those are typically a product of new construction. So when a new development is happening, depending on the size of that unit, if it's more than 10 units, they would be required to pay a fee, and the fee can be waived by producing units or offering a percentage of the building, the units to be priced below market rate. So the pricing is set by the Mayor's Office of Housing, and there's a selection process, but they're essentially the same units that you would see in the market rate building. The tiers for the income on the BMRs are, there's 3 different tiers. And so there's units that are priced at for 80% AMI, units that are priced for 105% AMI, and units that are priced for 130% AMI. And just to kind of give you a sense of what that means in terms of real incomes, 80% AMI for a 1-person household right now is $74,600. And if we went to a 4-person household for 130% area median income, that'd be about $173,100. And so, it's a pretty big range, and the units, again, are priced according to what the mayor's office calculates would be affordable for households of that So I just want to do a little bit of myth busting really quickly before I wrap.
Yeah, and Shannon, we'll come back to you, but if you can wrap it up and we'll kick it to Tom.
Absolutely.
But myth bust for us, and then we'll send it over. And then we're gonna have more questions and a chance to share more.
Absolutely, yeah, thanks. So, we commonly hear, BMR requirements increase market price and make it so that the market rate units have to pay more for their units. And really the short answer of that is false. Market prices determine what something will sell for. We wouldn't see a developer in the market rate, benevolently offer units for a cheaper price because, they didn't have an inclusionary requirement. And, even if they wanted to price them lower, probably their investors wouldn't allow that anyway. So, it could be, you could make a case that because BMRs do influence whether a development actually can happen or not, that sort of, in a less direct way, there might be an impact to prices, but, the market is what the market is. And, developers aren't going to really be able to sell the units for more or less than that, just based on inclusionary requirements. That's a common misconception that I'm always trying to clear up with people and just, not have that negative feeling in the air about the inclusionary. Thank you very much.
Okay, thank you, Shannon. Tom.
Yeah, I'm Tom Collishaw. I'm the CEO of Self-Help Enterprises. We're based in the San Joaquin Valley and exclusively serve 8 counties of the Valley. We've been around since 1965. And one of our cornerstone programs is a homeownership program. And we approach our homeownership strategies. We really have 4 ways that we do homeownership. The first is what we call our mutual self-help housing program. I'll go into more detail in a moment about that. We also assist local cities and counties to operate homebuyer assistance programs and access funds to do that. Thirdly, we do some infill development, conventionally built single-family homes and ADUs, as well as some acquisition rehab of single-family homes. And lastly, we do homebuyer education and housing counseling, similar to what Darris, what somebody else talked about. Well, Shannon talked about. So talk a little bit about mutual self-help housing and what that is. It is first and foremost a program that's based on sweat equity. We started this work after a pilot project in the early 1960s in the San Joaquin Valley. What kept coming back when you asked farm workers, mostly Latino farm workers, what they wanted most, what their priority was, and they wanted to own a home. So we pioneered a program where we could get them together in groups of about 10 at a time, and they would agree with one another to share labor to build their first home together. And our organization would provide the technical assistance for them to do that, including on-site construction supervision. And the way that differs from, noticed that one of my colleagues from Habitat is here. Not only does the sweat equity, the labor they provide essentially a down payment, but they also, what's a little different about our program is that labor requirement is to build one another's houses. And what that means is all 10 houses start on the same day, and then nobody moves in until all those 10 homes are done. So it's that shared labor requirement. They're relying on one another to build the houses together. So to give you some sense, of the scale of that program, since inception, we've now done over 6,500 homes in that program, mostly in rural areas. We rely pretty heavily on federal funding through the USDA rural development programs that have a great direct mortgage product that is subsidized down to as low as 1% for people who participate. And they also provide grant funding to nonprofits like Self-Help Enterprises who do this work. And it's really a turnkey program where we recruit families into the program. We get them give them the credit counseling, home buyer education that they need. We help them apply. We package loans for them to apply. We develop the subdivisions so the lots are available for them to build on. And then we take them through loan closing and then construction of the home until completion. And so it is, the results are really remarkable. Not only does it create that stability that Leo talked about, so that we know that they can afford these homes, not just today, but well into the future. It's really permanently affordable. And the wealth building outcomes also come along with that, because people are, can earn equity, and we've seen all kinds of families move on and their children move on to, greater heights, and the economic stability has allowed people to start their own businesses, send their kids to college, any number of, really positive outcomes. One of the things I definitely want to make clear is that we work in an area that's different than the Bay Area, in terms of costs, housing costs and prices. I would say, though, I often remind people, though, that while the values are much higher and the costs and the prices are much higher than we're contending with, our area median incomes are also, proportionately lower. And it's important to note that in our self-help housing program, we actually serve over 40% of the folks that we serve are actually very low income, so below 50% of area median income. And the balance are up to 80%, but we don't serve anybody over 80% of county median income. So it's a program that's worked. We've, with our other programs to help affordable home ownership, we've also helped about another 3,500 families. So we're up to over 10,000 positive ownership, home ownership outcomes. We also do rental housing, traditional affordable rental housing. So we see the differences between the two, but we also get some of our best home buyers and home builders out of our rental housing units. So, but thank you.
Great, thanks, Tom. And that's impressive that you're able to reach such low incomes, because I know in lots of parts of the states there are affordable homeownership programs. When you look at who's able to use them, it's really only people at the top slice of the income spectrum that's eligible, and those spectrums can be skewed pretty high. So that's really impressive. Sarah.
Thanks, Leo. Thanks, everyone. Sarah Scruggs from the Northern California Land Trust. I wear a lot of different hats here, but one of them is stewardship and education coordinator. So I support all of the homeowners and cooperatives that are a part of the Northern California Land Trust. And I have just a few slides because I know that for some folks, the Community Land Trust model is not as well known. So just wanted to take people through that real quick. We've been around since 1973, but didn't really have our first project until the 90s. And so we right now have about 125 homes that are across mostly in the East Bay, and also support the incubation of other community land trusts across the Bay Area, and are working with some folks in Vallejo right now on that as well. And homeownership is a main focus of the first projects that they're going to have there. One thing that I think is important to know about the Community Land Trust is that it is community controlled by the governance on its board. So residents that actually live in the homes that are on CLT land, a third of them make up the board. A third of the board are community stakeholders, and then a third are also have expertise in certain areas that the land trust focuses on. This is a graph that I like to show. The cost of structures, that blue line there, this is looking at Oakland. It does increase over time, but it's not as volatile as the land value. And so the idea of a land trust is to take that red line out of the equation in order to promote stability, but then also the ability to build equity for folks that are in home ownership situations as well. And there's lots of different housing types that can exist on community land trust land. We have single family homes, we have limited equity condominiums, and we also have limited equity housing cooperatives, which is a different way to look at ownership and a collective form of ownership. And before I go into that, just wanted to explain the kind of the separation. The land is owned by the community land trust, by the community itself, in order to ensure ongoing affordability, protection from speculators. And then the structures on top can be owned by the residents themselves and in a variety of different ways. And it's this 99-year ground lease that exists between the two that ensures ongoing affordability, the ability for owners of the structures on the land to be able to pass down the home to their heirs to build equity, but then also make sure that it's available as a community resource for folks in similar incomes into the future. And, a little bit more about, I'm going to mostly focus on limited equity cooperatives because they're just not as well known. And I think it can be a good way for a lot of folks that haven't had any access to homeownership because of how volatile the market is, because how high the market is, to be able to get in. So it's where, and we're often acquiring existing buildings. So they could be multifamily properties where tenants have been living for a long time, or even single family homes. But when it's a multifamily building, that's when the transition to a limited equity housing cooperative is more possible. And so there's a blanket mortgage that the co-op would have that they would be paying down on. And then each co-op member would have a share, which per California law can only increase at 10% per year. And so they have that share that can also increase in value, and the unit that they have a proprietary lease to that can be passed on to their family. And so equity can be built within the share itself, and then equity can also be built as the co-op pays down that collective mortgage. And so, what's different between this and, an individual getting a mortgage themselves, sometimes it's not possible for folks to be able to get into the market right away because of their credit history, lack of access to being able to build their credit, and then just other issues that exist within the banking realm. So cooperatives are also a really important form of homeownership that we promote at the Community Land Trust, and other CLTs are promoting across the state as well. And that is enough with my slides. I think that, I guess the last thing that I would say, before I moved to California, I was in Washington, D.C. for 15 years. And I actually noticed one of my former colleagues is actually on this call. Annalise, you're out here in California now too. And one thing that really shocked me moving to the Bay Area, and I guess this goes to a little bit of what Tom was talking about, is just how expensive and how high the costs are here. It was just shocking to me. It's almost like this is what the end of capitalism looks like. Everybody is like priced out. Yeah. And so I think, innovative ways in order for community to have control, for people to be able to have stability, but also be able to build equity and create something that is a long-standing asset for their family, but then also the community at large and people that are low income, is so important. And especially in the Bay Area and across the state of California. So thanks.
Thank you, Sarah. Great to get a feel for these different models, right? We have kind of multifamily homeownership that Sarah's describing, and I think Shannon also, some of those programs are talking about multifamily homeownership. Tom's talking about self-help mutual aid homeownership. So kind of, broadening what people imagine when they think about with homeownership, which is usually like single family home with a white picket fence, something like that. So Darris, I see you have a hand raised. You want to jump in?
That must have been a mistake. I was trying to give her a thumbs up, but
okay, hey. yeah, that's the same. That's the same way, same thing. So the next question I want to throw at you is about opportunities and challenges you're seeing in your work, and we got a taste on some of those challenges from all of you, but I thought it might be interesting to start with Tom. since you are working in a different environment, and you mentioned that you're dealing with maybe even lower income folks, even though housing prices aren't quite as high as the Central Bay Area. But it would be great to hear about some other challenges in doing your work there, as well as opportunities. And then I'm going around to any other panelists who want to chime in.
Sure, I'll definitely mention a few, and you know, we have had something like 30% increases in home prices in the last year in many of our markets, which is creating fairly significant challenges. So just like rental housing development, you're always filling gaps, right, for the people that are, and so it's the scarcity of resources that continue to be a challenge. We rely pretty heavily on resources like Cal Home program, which is a home ownership assistance program. It's got some challenges in and of itself working for folks, but that is just for low income home buyers. We also have, there's some state funding streams that don't lend themselves to easy access for home ownership programs, including the Infill Infrastructure Grant Program and AHSC, Affordable Housing and Sustainable Communities. I don't think many people have made a way for those to work. Maybe Sarah could actually, but the kinds of densities that they require really are more, at least in our markets, would be entirely out of scale for home ownership type products. So we have those kinds of things, and I'd say that, you know, in general, our feasibility equations for home ownership are different, because not only do you need to fill a funding gap, which you always do in affordable rental housing development, for instance, but you're also having to have projects work. And for us, that means if somebody puts 1,500 hours of labor into something, they have to get something for that. There's got to be real equity there. And as the market fluctuates, you can get into some you could have a project that looks feasible today, but a year from now doesn't look feasible. So there are some real risks and some challenges involved that go beyond just filling gaps with more and more subsidy.
Interesting. And I'll open it up to the other panelists to jump in there.
So,
Oh, Darris, go.
oh, you go. So one of the things, you know, that I just talked about prior is that, you know, BARHII, we have structured an ask from the state that would create this virtual cycle of funding for Black Housing Finance Pool. And that would look to, you know, create down payment assistance for Black home ownership, pre-development and acquisition for our developers, and then also, you know, asset retention, and the fund would be in the range of $500 million. Now, these are the challenges that we are seeing with this right now. Even though we know the numbers of the disparities on every side of housing, right? They are outweigh, you know, when it comes to African-American communities. And then I also think, you know, our Native communities as well. There are these large disparities. But the challenges come up in two areas. The challenges come up with, well, in order to do this, how do you get around Proposition 209? Right? Because Proposition 209, it actually, you know, does not endorse race-based policies, right? And so that's one of the areas that is a challenge. And I think the other area that we're seeing that is a big challenge as well is the Fair Housing Act. Because even with the Fair Housing Act, and you have to remember, you know, how that act was created, you know, when it was created and how it was created, you know, it was actually, you know, to get fairness for African Americans with redlining and all these other policies. But now that's a policy that might prevent the structural or just the looking at how you get people into communities. And I'll give one example of what is showing up. So I think it was earlier, and I can't recall the date or the year, but it was a church, one of our most prominent churches that exist in Oakland. It's called Actual Gospel. They invested in building housing in the neighborhood that they thought was going to house most of their parishioners. Well, they were able to build the housing, but at the end of the day, because of the laws and the lottery system that was put into place, more than half of their parishioners that they were seeking to get into those housing did not get in, right? And so I do think that, you know, on a policy scale, now, we know, just as Sarah rightly pointed out, you know, California capitalism is impacting people in droves of all colors when it comes to housing. But when we look at the scales of equity and these long-term things that have always impacted African Americans in housing, and I think the case was made with Richard Rothenstein in his award-winning book, The Color of Law, we also understand that those policies were embedded and reinforced by government. And so I think, and I know we're not talking about solutions, but government needs to focus on, you know, those policies that will undo years of discrimination, things that kept us from getting asset retention, appraisals, and all these other things that would have gone into generational wealth, so that at the end of the day, the young people who are coming out of college, graduating from high school, or whatever, and that represent these communities would have a fair opportunity to be able to get into housing within themselves.
Thanks, Darris. And you know, it's interesting in amongst the community land trusts across the state, this question of how to navigate fair housing and lottery rules has been a big challenge for the same reasons you're giving, right? Even if it feels in the spirit of the Fair Housing Act to, you know, target people who need the housing most in your area, those laws are now a big obstacle. So thanks for raising that.
One of the big issues with down payment assistance with the DALP is that you're chasing a moving target, right? As long as prices are continuing to go up at the rate that they have been on the market rate, you know, at a certain point, it gets to where, you know, you're just hemorrhaging city money into an unregulated private market. And we have to kind of ask some hard questions about up to what point are we willing to do that? You know, you have to be able to counter how expensive things are in the market, but you know, at a certain point, it becomes a resource utilization issue. And then the other problem that I think impacts both programs and pretty much anything that's tied to area median income, probably a lot of the other panelists programs as well, is that area median income is also being artificially inflated by displacement. Gentrification, by definition, is lower income households having to leave and higher income households moving in. And so, you know, what we do see is that AMI is going up much faster, you know, certainly not at the level of the market, but, you know, the market rate units, but for the income thresholds for our programs, you know, those are just getting sky high, and, you know, really are a challenge for people who haven't seen their wages go up in any kind of real or meaningful way, you know, and certainly not to that level. And then the last issue that, you know, I think is particularly a problem with BMRs, but we see it, you know, with DALP as well, is homeowners associations. Collective stewardship is not an easy thing to do, as the land trust, I'm sure, could give lectures on. And so, you know, being able to make sure that there's reserves, that can be very challenging, making sure that people are participating. And then the cost of maintenance and repairs and everything is just going up. And so, you know, that is also, you know, prohibitive as well for somebody who's, you know, already HOA dues are sort of averaging $800, $900, you know, over $1,000 a month on a project. You know, for those to go up really has a significant impact. If anybody's actually working on HOA issues, I would love to talk to you more. I know the city of Mountain View recently passed some legislation to help alleviate some of those cost burdens associated with HOAs, but definitely, we're looking to kind of put together an alliance around that and potentially talk about, is there a way that, state legislation can be adjusted? Because right now our state legislation actually says very specifically that market rate HOAs cannot subsidize BMR homeowners. And so, those dues need to be set the same, regardless of whether someone's in a BMR or market.
Thanks, Shannon. I see Habitat Greater San Francisco looks like they're also looking at these HOA issues. So I hope you can connect. And before I hand to Sarah, I just want to encourage folks to put questions into, there's like a Q&A portal. Or if you have trouble finding that, you can put them into the chat and we'll circle back to them in a moment.
Yeah, I mean, all of you have brought up challenges that are really familiar to us. I definitely agree when you've got mixed home ownership as far as market rate and below market rate in a building, not having the ability to have a difference in what people are paying condo fee wise is a huge, huge issue. When I was in DC, that was massively huge, although there wasn't a law preventing folks in the BMR units to pay less. So that would be a huge move forward if that was allowed in California, because it does make a difference. Yes, cross your fingers. And I also think when you're creating collective ownership as well, it's important to really be thinking, I know that things have changed so drastically as far as costs, even since NCLT started its first project in 1990, but like really thinking ahead of time of like setting the carrying charges or the HOA dues at a good rate so that people aren't, are able to build their reserves collectively and aren't stuck with having to make some really, really big changes in the future in order to cover costs. And there needs to be, support for when people do get into trouble. You have access to rental assistance, but there isn't a lot of access to folks that are in limited equity condos or limited equity housing cooperatives if they themselves need some assistance. They're also impacted by the economic downturns of things as well. I think some other challenges, and it's similar to what Tom brought up, we're acquiring often existing housing. And so just enough gap financing in order to make that purchase and then turn around and sell that home or transfer, ownership to somebody at an affordable rate and be able to have financing that can really stay in the deal. We worked really hard with a woman named Jocelyn Foreman, who was able to use Senate Bill 1079 in order to purchase her home that she was renting out of foreclosure. And, there wasn't an existing pool of money for us to make that happen. We kind of just got lucky that she's an amazing person and connected with amazing people that were able to fundraise, and we were able to get a community development financial institution to give us a crazy last minute loan. And so now we're working on the hard work of like, how do we make this affordable for her long-term to be able to truly take it over as an owner? And so we're going to be using some Cal Home money, but then I've also advocated with the state for people that are in a similar situation as her in the future, be able to have that access to capital to keep homes from going through foreclosure, keep people housed, and actually give them an ownership stake that's affordable for them and others into the future. And then when it comes to limited equity housing cooperatives, there's a lot that needs to change on the banking side. There aren't a ton of institutions in California that give share loans for people that are becoming co-op members. And so that's another challenge as well. And Darris, I'm really glad that you brought up issues around race and housing and how you can target things. I know a lot of local jurisdictions are looking at preference policies, and they can't do direct targeting for people based on race, but they are trying to figure out like, how can we focus on folks who have been displaced and make that like part of the qualification for being considered for buying a place or getting into affordable housing. And that'll make a huge difference in Berkeley, where the Black population has just been decimated and so many Black households have been pushed out. But there's a lot more work that has to be done on that for sure.
Thanks, Sarah. And now I'd like to open up to questions from our attendees. So again, you can stick them in the chat or in the portal. And we have one that's directed at Sarah, but I would be interested to hear the answer from anyone, which is about tenants in common. So the question was if CLTs ever work with tenants in common model, but I'm very new to the tenants in common model. And so interested to hear if that's something that any of our panelists encounter and use in their work.
Now I see, Eileen, that you said tenants in common. I just saw common model and I was like, what is a common model? So I do know TICs. We have not ever worked with that within NCLT. I know that TICs have been used in San Francisco as a way for people to be able to purchase property. And there's some controversy around that. But it is a model that's out there that could be used. And there's been a lot of talk about how to use that with some of the tenant opportunity to purchase acts that are being considered in places around the Bay Area for when people's, homes that they've been living in have gone up for sale, and would TIC be a model that they could use to acquire that building and then take out and transfer for them each to have their own loans. But I've got to be honest, we haven't used it. We've just been like brainstorming around it. So if anybody else has an answer, that'd be interesting to me too.
We have not used a tenants in common model.
We haven't used that, but we certainly see a lot of TICs and we have fractionalized financing there, so people can buy and sell in and out without, just for share without having to adjust the whole group loan, which I think, makes a lot of people think of it as a condo alternative. The biggest difference, though, it's not. It's not managed by a professional company. Usually, they tend to be smaller units. You get in particular trouble when you have even numbers of units, and so there's going to be ties. We've seen a lot of people who are in TICs and they're fine, and they have very strong TIC agreements that were written by good lawyers who know what they're doing. And I have seen some absolute disaster, like hellacious, just nightmare scenarios. Due to TICs, just again, that collective stewardship of resources, particularly when your largest investment is tied up in that financially, like that is not easy. Like that is a really hard thing that takes a high level of support, of education. That really is where, the land trusts, I think, excel and shine, in being able to provide that ongoing support. And being that TICs don't get that, I mean, you come up with some crazy stuff. I saw some clients negotiate for 9 months over what color to paint the house. And literally in the end, the way they made that decision was by picking the color that they all hated equally.
Whatever works. So we just have a couple minutes left, and I'm hesitant to throw out like a big question, but I'm curious. I don't think the word foreclosure has come up once, maybe in passing. And I know that when you talk to policymakers or banks about homeownership for low-income people, that's the first thing that they'll jump to. And I'm curious if, has it not come up because it's not a concern, or you feel like you have systems in place in your organizations and programs that kind of mitigate risk of foreclosure for low-income families, or some other reason?
I'll jump in quick on that. And it was interesting that during the crisis starting in 2008, the whole real estate crisis and foreclosure crisis that ensued, we had virtually nobody who had built a home or gone through one of our programs who lost a home involuntarily during that time. And we ascribed that mostly because they were prepared for home ownership. They got into a deal that they could afford, that didn't have any tricks, in their mortgages. They didn't, there was no, crazy self, stated income kinds of things. And those folks were solid. I mean, we did counsel a few people who were worried that they were going underwater. And we said, well, what's your plan? Well, I want to stay here. Okay, well, you could still afford your monthly payment, make your payment. Markets, go up and they go down. and those folks turned out fine. We've done surveys that show that our folks stay in their homes longer than the average Californian homeowner who moves. I think it's something like every 6 or 7 years. Ours stay 15 to 20 and often more. They're building a home for their family. So it's not that we don't worry about foreclosure. We just we don't see it because we think we're doing it right. We think we've been vindicated.
That's fantastic, Tom. I love hearing that, actually. Our housing counseling agencies do foreclosure prevention and counseling, helping people to negotiate with servicers. And thank goodness, finally, our state mortgage assistance program has launched and is now available to help support people. Took them a while to get that open and out there. But, I think that where we have done a lot of work around foreclosure prevention is actually for with the tax assessor's office. We work with people who are behind on their delinquent taxes. A lot of them tend to be senior citizens, people who've owned their home a long time, have a significant amount of equity. You don't want somebody to lose a home that's worth that much, over $60,000 of they haven't paid their taxes in several years. So we do a lot of that. It can, and by a lot, I mean like maybe 20 or 30 cases a year. In terms of the sort of general population, it comes and goes. I mean, there were certainly 2008, 2009, 2010, that was crazy. We would have hundreds of cases every month, but that, fortunately, COVID has not brought us to that level of desperation. And I think that some of the lender initiatives and protections that went into place helped to sort of prevent that from being a larger issue.
Great. But I think we're at time. I bet a bunch of people are going to jump into 1 o'clock Zoom meetings right now. So let's thank our panelists, Darris, Shannon, Tom, Sarah. Thank you very much. Thanks, MPH, for having us. And everyone, have a great afternoon.
You too. Thank you, everybody.
Thank you. Bye-bye.